Hello, and welcome to the video on shareholders' equity, dividend payout ratio, and return on common equity using PepsiCo's 2017 annual report. This allows you to have a more in-depth look at real annual reports than your textbook, and this material is discussed in your textbook in Chapter 11. So, the income statement for PepsiCo in 2017, there are several items that pertain to common shareholders. At the bottom, we say how much net income is attributable to shareholders of PepsiCo and not to non-controlling interest and other things. We can say this in a total dollar amount, about $4.86 billion. Or if you own one share of PepsiCo, they put it on a per share basis. PepsiCo and other companies must calculate net income per common share on a basic basis, meaning taking net income minus any preferred stock dividends over weighted average common shares outstanding. That was $3.40 in 2017, or on a diluted basis, which means that anybody that has convertible preferred stock outstanding and stock options that could convert it to the detriment of common shareholders, they assume that this is done. So we also have for PepsiCo, which is unusual, they actually give us the cash dividend declared per share of 3.1675 cents per share, although most companies do not. Okay, on PepsiCo's 2017 balance sheet, there's a whole section on shareholders' equity, and it begins with preferred stock. PepsiCo has an unusual and small amount of preferred stock related to an employee stock option plan for Quaker employees. Remember, it did take over Quaker Oats. Most companies outside financial institutions have little or no preferred stock, and we'll see a little bit more about this in the footnotes on the next slide. If we're looking at common shareholders' equity for the year ended December 30th, 2017, first, notice that PepsiCo's common stock has a par or legal value of 1 2/3 cents per share. Shares of PepsiCo sell for much, much more than this, and this is the amount that they got from shareholders when shares were issued, which could have been many, 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 many years ago. Since shareholders contributed a lot more than 1 2/3 cents per share, the difference goes into capital in excess of par value. So this is based on what shareholders gave at the time shares were issued. They could issue up to 3.6 billion of shares, although most companies don't issue all the shares they're entitled to, leaving room to issue more shares should they need it to grow. PepsiCo has shares issued of 1.866 billion. Most companies tell you the number of shares issued, but PepsiCo tells you issued net of repurchased shares, which is shares outstanding. Even though it doesn't tell you shares issued, you could take the outstanding shares, 1.42 billion, and add the 0.446 billion that it repurchased from its own shareholders, or treasury shares. Again, of 446 million. And shares outstanding, 1.42 billion. So remember that it includes retained earnings. It also includes accumulated other comprehensive loss. That's a little beyond the scope of this course. And there's a deduction for all the shares that it repurchased. Now, what about this non-controlling interest? This is a topic mostly discussed in advanced accounting. It's relatively small for PepsiCo, so it's not that important. But non-controlling interests are the part of equity in a subsidiary that PepsiCo doesn't own, but has a controlling interest in, meaning it owns more than 50% but less than 100. So if PepsiCo owned 90% of a company, it would consolidate, add its assets and liabilities to PepsiCo's assets and liabilities, but it would have to remove the earnings and the assets for the portion of the subsidiary it doesn't own. So this is because not all takeovers involve controlling 100%. Okay, sometimes these little words or these big words with little numbers get people scared of looking at annual reports. Let's look at the statement of equity to find a little bit more about, well, what do these shareholders get for dividends? We've already seen the retained earnings column in the statement of shareholders' equity will show beginning retained earnings, which was also at the end of 2016, net income for common shareholders, $4.857 billion from the income statement. It deducts cash dividends declared in total of $4.5 billion, and then you'll have an ending balance. They have information about cash dividends for preferred shares. Even though PepsiCo has preferred stock, they really didn't declare preferred share dividends this year. And the one reason for this is that they decided they were going to buy all these preferred shares back and convert them into PepsiCo common shares. So this was one reason they did not declare dividends. The year before, in 2016, there was only $1 million worth of dividends. So it was a relatively small amount to begin with. And ending balance of retained earnings is the ending balance on the balance sheet. So what can we do with this? We have a couple of profitability ratios, one of which is the payout ratio. Profitability ratios measure the company's income or operating success over time. I might argue with classifying the payout ratio as a profitability ratio. It's more what you're liquidating to shareholders, but I guess if you don't have income, you're not really going to pay many dividends. So it's cash dividends declared on common shares divided by net income for common shareholders. Cash dividends declared on common shares from the statement of equity. And remember, the amount of cash paid in dividends can be a little bit different than this, because you might declare a dividend in December and pay it the next year in January. We already have net income available for common stock, so we get a couple of payout ratios. PepsiCo had a really high payout ratio of 93%. Almost all of its earnings it paid out as dividends to shareholders. 93 cents of cash is a dividend to common shareholders for every dollar of net income. PepsiCo in 2016 had a payout ratio of 68%, which was considerably lower and more in line with that ratio from prior years. The higher payout ratio in 2017 is due to a one-time reduction in net income because of the Tax Cut and Jobs Act of 2017, a one-time tax of repatriating earnings in foreign country, or taxing earnings in subsidiaries in foreign countries. One thing you'll notice is not all companies pay dividends. Mature companies with steady earnings like PepsiCo often have a high payout ratio. It doesn't have a whole lot of new investment opportunities, whereas a startup company or a company that is losing money might try to conserve the money, keep it reinvested in the company. They don't want to pay big dividends if they can put it to better use for shareholders by trying new investment projects. So the payout ratio in and of itself doesn't mean you're profitable. It's more of a dividend policy, which you'll learn more about in your finance courses. Return on common equity is more of a pure profitability ratio, and this says take net income for common shares, subtract any preferred dividends, and divide it by average common shareholders' equity. Well, we have these figures from PepsiCo. Notice that net income's a lot bigger for PepsiCo in 2016. PepsiCo had one preferred share, $1 million of preferred stock dividends, and none in 2017, which we discussed earlier. We would average these two common equity figures to get average common equity. I didn't put the average on here because I needed a little more room below for the explanations. And we get return on common equity, 43.6% in 2017 versus 54.3% in 2016. Well, in 2017, PepsiCo earned 44 cents on every average dollar of common equity invested versus about 54 cents in 2016 for every average dollar invested in common stock. That's based on the accounting value of common stock. PepsiCo was less profitable in 2017 than 2016, and the main reason is ROCE decreased because net income available to common shares decreased due to a one-time effect from the Tax Cut and Jobs Act in 2017. One thing you might notice is that PepsiCo's and a lot of other companies, their ROCE, return on common equity, may look large compared to a company's stock market returns. That's because the book value or the accounting value of common equity is less than the stock value, what the stock market values a company's equity. One reason is because accounting equity excludes the value of internally developed intangible assets like the Pepsi brand. Pepsi developed that in-house. If it bought a brand from another company, fine, you can have that as an intangible asset. But you cannot, when you develop your own brands, like PepsiCo did for Pepsi, and also drug companies often do this when they get a patent on a brand new drug. Very little of that is on the balance sheet if they develop it in-house. The stock market looks ahead, not at just past earnings, but what it expects the company to earn in the future. And usually it expects the company to earn more of normal or above normal future returns, and sometimes these returns might grow. This is not included in accounting. Finally, the denominator would be lower for accounting ROCE than it would be for stock return because average common shareholders' equity does not include any increase. One is not allowed to write up property, plant, and equipment in US GAAP or intangibles after you buy them. So these things are excluded, making the denominator look smaller and return on common equity look bigger compared to the stock return for PepsiCo. Please feel free to use this presentation as a review before looking at other companies' annual reports for the weekly discussion board. Good luck and get started, Jaspers.